A very good morning to all. My name is Diksha Verma. I am working as Assistant Professor in Chandigarh Business School of Administration, CGC, Bangalore. The topic for my presentation is bank insurance. Bank insurance is basically when banks sell insurance policies of insurance companies to their own customers. Okay, so starting with the definition, it is convergence of two words, that is bank plus assurance, which means that banks provide assurance to the customers through selling, or you can say by selling of insurance products of insurance companies to their own customers. This term was originated or coined in France in the year 1980, which referred to an arrangement between the bank and insurance company, wherein the insurance company markets or sells the products and services to bank customers. Simple, as I told you, when bank sell insurance products of insurance companies to their own customers, right? It is basically when bank act as a corporate agent for insurance company, right? So bank insurance will act as a corporate agent to sell life insurance as well as general insurance, or you can say non-life insurance products. Like if you go to the bank, if you want to buy a car and you want bank to give you a loan, right? So for taking bank loan, you also want insurance of that loan. So basically that is bank insurance. When you go to the bank, bank will tell you if you want to avail a loan from the bank, we can also provide you insurance for that loan. Even suppose if you are not able to repay that loan in time, so you can take insurance for that loan. So basically that is bank insurance. Bank insurance is basically of three types. You can take insurance for your deposits, you can take insurance for loan, and you can take insurance as a simple insurance like health insurance, life insurance, etc. So with the help of this arrangement, both the banking and insurance needs of the customers are fulfilled and satisfied in an effective way. Bank insurance is basically a win-win strategy or a win-win system for all the parties involved in it. There are three parties involved in it: bankers, customers, and insurers. So it is a win-win situation, you can say, for all the parties involved in it. Let us take an example of bank insurance. Like Central Bank has collaborated with Life Insurance Corporation and Tata AIA Life Insurance Company for carrying out their life insurance business. However, it has also collaborated with New India Assurance Company Limited and Bajaj Allianz General Insurance Company for carrying out its non-life insurance business. Like if you go to a bank, you want to take a home loan or you want to take a car loan, for that purpose, a bank also provides you insurance. So this is basically bank insurance. Okay, for getting a license for bank insurance, banks need to secure the prior approval of Insurance Regulatory and Development Authority to act as a composite corporate agent of insurance companies, as well as it has to take same approval from RBI. Even if bank wants to sell the insurance products of any other insurance company, or if it wants to sell insurance on its own, मतलब उसका खुद का प्रोडक्ट हो सकता है वो इंश्योरेंस, तो उसके लिए उसको IRDC DSA की परमिशन चाहिए, and it also requires permission from RBI. Okay, so there are two types of bank insurance, as there are two types of insurance products: life insurance products and non-life insurance products. Same or similar way, there are two types of bank insurance products. First one is life insurance product. There are three plans in it: term insurance plan, endowment plans, unit linked insurance plans, and another is non-life insurance products, in which you have different types of insurance like health insurance, marine, property, human insurance. Bank insurance is similar as a simple insurance. The difference is this, that banks sell the insurance products of insurance company. That's why it is termed as bank insurance. Okay, now the meaning which basically defines the whole process of bank insurance lies in the models which are used for selling bank insurance products, right? So there are broadly two types of models. First one is structure based classification, product-based classification. On the basis of these two models, bank insurance process works, or bank insurance model or bank insurance system works, right? So in structure-based classification, there are three types of models. First one is referral database sharing, second is corporate agency model, and third is fully integrated financial service or joint venture. This is basically a joint venture model, right? Under product-based classification, there are two types of categories under it. First one is standalone insurance product, and second is blend of insurance with bank products. It is kind of mixture, right? When we talk about these three models, basically banks follow any of the three models written here. These two models are basically mixture, right? If you are going for standalone insurance product, this is not a separate model. This basically includes referral and corporate agency model, and blend is obviously a mixture. Let us take a detailed note on this. First one is referral database sharing. Under this model, what happens when insurance company wants to sell its insurance products to the banks? They charge, banks basically charge a reference fee, or you can say a referral fee or a commission, and in return they provide their database of the customers to the insurance company, right? Under this, what is happening? Insurance company is here. It is taking help of the bank for the account holders, but basically for the data of account holders in that particular bank, and they are referring their insurance products to those customers of that particular bank. So basically this is referring model, or you can say database sharing. Database sharing means where database of the bank customers is shared with the insurance companies, right? So referral model is nothing but it is a simple arrangement where the bank, while giving access to the client's database, parts with only the business leads to the agents, sales staff of insurance company for a referral fee or a commission. That's why it is called referral or database sharing for all the business lead that was passed on. So here the meaning concludes, basically all the business leads that are passed on by the banks to the insurance company, and in return for that, insurance company pay a referral fee or a commission to the bank. This particular model is suitable for all types of banks, including RRBs, cooperative banks in rural as well as urban areas, because banks does not need any prerequisite capital in this, right? Bank does not require to arrange a premises. Bank does not require any particular staff member or any person to whom they can shift upon this burden of selling insurance or converting potential customers of insurance into actual customers of insurance. So this is basically a referral database sharing where you refer something and charge a commission for the same, right? In second model, that is corporate agency model, here bank act as actually a corporate agent, right? So under this model, bank staff is trained to appraise and sell the insurance products to the customers. Under this model, what happens? Banks basically train their employees to sell insurance products of insurance companies. However, they are also given targets of converting potential customers of insurance into actual customers of insurance, like any other salesperson. Right? If bank is hiring an employee for selling credit cards, it is like a same thing. Bank is hiring a person for selling insurance products of insurance companies to the bank customers, right? Hence, bank as an institution acts as a corporate agent for insurance products for a fee or commission. If for that purpose also, it charges a fee or commission. This model is basically a non-risky model in which bank gives training to its employees to sell insurance products to their customers for which they charge commission. However, here also there is no prerequisite of capital, and there is no premises required. So bank here also is in a win-win situation. It only has to train give an incentive to the employees so that they can sell insurance products of insurance companies to bank customers, to their own bank customers, right? Last model, it is fully integrated financial service or joint venture model. This model is very important and is also prevailing nowadays. Banks are trying to adopt this model for selling bank insurance or for selling insurance to their customers because it has been seen in researches or in the reports, annual reports of the banks, that banks are earning incomes through selling of insurance, and people are also trusting, customers are also trusting banks for taking insurance rather than taking insurance from insurance agents, right? So this involves much more inclusive and intrinsic relationship. इसमें हम देखते हैं क्या होता है, fully integrated financial service or joint venture model. It is more inclusive and intricate relationship between insurer and bank, where bank sell insurance product as one additional product like others. Bank, what does bank do? It does not train its employee, or it does not charge a fee for selling insurance product to their customers. But what it does, it sells an additional product like any other product. Like if it is selling credit card, it is selling debit card, it is providing loan, it is providing deposit services. Like same like that, it is providing insurance to their customers. So this includes wholly owned insurance subsidiaries with or without foreign participation. Like ICICI Bank and HDFC Bank in private sector are leading for their bank insurance income because they are basically following this model. And another is SBI in the public sector. It has also started taking lead in this type of bank insurance model. So this type of bank insurance model is basically suitable for the banks having strong and sound financial infrastructure, because for this purpose they require prerequisite capital, they require premises for selling insurance products, right? So this is the main structure-based classification on the basis of which bank insurance works in different types of banks, right? Another type of bank insurance model is product-based classification. As I told you earlier also, these models are not another classification or another type. These models are somewhat related to what we have already discussed in our previous slide, right? So first one is standalone insurance products. Standalone insurance products, under this model, bank can either use referral model or can use corporate agency model without mixing insurance product with any of the bank's own products or services. It is a separate product which bank is selling or marketing to their customers for a referral fee or a commission, right? So it is standalone. Standalone means where it is standing alone and not with any other thing, right? So under this model or under referral model or corporate agency model, what bank does? Bank basically charge a fee or a commission and sell insurance or market or promote insurance products of insurance companies to their customers, right? So it involves marketing of insurance products through either referral arrangement or corporate agency without mixing insurance products with any of the bank's own products and services, right? For example, Karur Vyasaya Bank Limited selling life insurance products of Birla Sun Life Insurance or non-life insurance products of Bajaj Allianz General Insurance Company, right? Another model is blend of insurance with bank products. This is basically a mixture where bank can use any of the model, right? Marketing is conducted by insurer staff and bank is responsible only for the generation of leads, right? Bank basically market the product and sell it to their customers, okay? And obviously they charge a fee or a commission for generation of lead, right? The database of the bank is handed over to the insurance company. It requires very little technical investment as well. So now I already told you that bank insurance is a win-win situation for all the parties involved in it, that is bankers, insurers and customers. So all the three parties have their own benefits. Let's start with the benefits to customers. What their customers can get from bank insurance, or what they are basically getting or benefiting from the bank insurance. Right. First one is complete solution. Obviously, if I go to a bank and bank provides me various services, like it is providing me deposits, savings account service, it is providing me loan service, it is providing me credit card service, debit card service, consultancy, any other, and same in similar way it is providing me insurance. So bank insurance का एक ये benefit. Right. Another benefit to the customer is convenience. Obviously, it becomes very convenient for the customer to avail every one of the service, each of the service from the bank at a single point of time. According to a research by EY, 32.5% of insurance buyers from banks rate convenience as the top factor for buying insurance from banks. Basically, it becomes very much convenient for the customer, as he is getting each one of the service of the bank from bank or under one roof, or you can say at one single stop. Right? Another benefit, that is trust. Yes, customers can trust their banks, obviously, and for deposit service they are trusting their banks, for loan service they are trusting their bank, as in similar way for insurance purpose they trust their banks. So according to a research by Copley and Rao, 75% of surveyed insurance customers prefer to buy insurance from banks due to an existing relationship or long-term relationship. Right. Another benefit is one-stop shop. Similarly, like I told you in the previous slide, that is complete solution. One-stop shop. It is like bank insurance distribution model allows the customers to get their insurance products along with an amalgamation of other financial services under single roof or at one single stop, where it is getting savings account, insurance service, consultation, loan service, credit cards, other foreign exchange services. Right? Another benefit is perceived expertise. It is already, mostly perceived, or it is the perception of the customer of a particular bank that if I am taking services of this bank, I am surely going to get expert advices from the bankers. Right? So, customer पहले से ही मान के चलता है कि जो भी एडवाइस बैंक से मिलेगी या बैंकर्स देंगे वो उनकी एक्सपर्ट एडवाइस होगी, एंड दिस इट विल बी वेरी बेनिफिशियल फॉर मी. सो दिस इज एन एग्जांपल, दिस इज एन एडवांटेज फॉर सेलिंग बैंक इंश्योरेंस प्रोडक्ट्स बिकॉज थ्रू दिस bankers are able to approach the customers, right? So, arising from the trust in their banks and the notion of professional expertise and the faith and that they will get proper advice to buy their insurance product, making bank insurance an easy sell for them. Another is ease of renewals. Yes, if you are taking insurance from bank, it becomes very easy to get renewal of the insurance policy, because if you are taking an insurance from insurance agents, it gets sometimes very difficult to renew that insurance policy. But if you are taking an insurance from the bank, bank is where you are taking other services from there also, so you can get a renewal of insurance as it is a renewal of fixed deposit account. Okay, next is benefits to the insurance company. Obviously, insurance company is getting benefits from the model of bank insurance. That's why it is adopting this model. So, first one is high market penetration. For an insurance agent or for an insurance company, it becomes very difficult to reach or to approach the customers who are basically residing or living in the remote areas, right? So, through bank insurance model, it has become easy. Why? Because bank, everyone is having bank account, whether any person is living in any remote area or he is living in any urban rural area, everyone is having a bank account. So, for insurance company, it becomes very easy to penetrate the market or to penetrate their potential customers of insurance. Right. Moving on to the next benefit to insurance company, increased premium turnover. This is one of the most important benefit. Obviously, if the number of persons increased, because if the number of persons who are taking insurance increases, obviously the premium turnover will also increase. So as a result of the market penetration, the whole market penetration, the insurance carriers' motives of increasing their premium turnover is also achieved using bank insurance. Okay, next is increased customer trust. Bank reputation is one of the top reasons listed by surveyed customers for buying insurance at the banks. Why customer trust their bank? Because of the long-term relationship, because of the reputation of the business bank, because of the services provided by the bank. So increased customer trust insurance. So as in the similar way, bank customer also start trusting insurance company, and they get the benefit of increased customer trust. Moving on to the benefits to the banks. What are the benefits that banks are getting? Obviously, they are getting a benefit of diversified customer portfolio. Diversified customer portfolio means their single customer is taking different kinds of services from that particular that single bank. Like if he is taking savings account service, he is also taking home loan service, he is taking credit card service, he is taking insurance service. So this is basically a benefit for bank, because bank is able to provide diversified customer portfolio to their customers. Okay, second benefit, improved profitability. As insurance companies are able to increase their premium turnover, banks are also able to improve their profitability through bank insurance. Okay. Third one is customer loyalty and retention. If I am taking a loan from the bank will approach me for sure for an insurance. That ma'am, what if you are not able to repay this loan, we will provide you insurance for this loan, right? So in this manner, what bank is doing, it is basically gaining my loyalty towards bank as well as my retention towards bank, right? If I am taking loan, I have to repay that loan, as well as if I am taking insurance, I will pay the premium. So customer loyalty and retention, it is an important benefit that bank gets through the bank insurance model. Increased customer lifetime value. Same way, like if I'm taking home loan and I want to repay that loan, what I will do, I will take insurance from the bank for that loan. In case I'm not able to repay that home loan, I will use that insurance which I have taken from the bank. Right? So increased customer lifetime value. With increased loyalty and stickiness comes a higher customer lifetime value per customer, which is very important merit for banks. Cost-effective use of existing resources. Bank does not require any different premises for selling insurance. Bank does not require any capital to be invested in this. Bank just need to train its staff. Or in one model, it does not even need to train its staff, right? So it basically helps in cost-effective use of existing resources, right? Operational cost reduces and the utilization of resources increases greatly because banks can use their existing premises and employees for selling with no additional investment. And insurance carriers can also provide specific training to the bank staff as well. Another is specialized training for the bank staff. Obviously, bank will train its employees or its staff to sell insurance products, and it will be a benefit for the bank only. What does it mean? Bankers will be able to convert potential customers of insurance into actual customers of insurance, and obviously it will also increase the turnover rate of banks as well as insurance companies. Right? So insurance agents, what does they do? They provide an extensive they have an extensive experience in selling insurance, so they train bank employees for selling insurance to the customers. However, moving on, if certain thing is having advantages, it is also having drawbacks or disadvantages. So there are certain drawbacks of bank insurance, but it does not affect this model so much because it is having advantages for each single party involved in it separately, right? First disadvantage or drawback of bank insurance is that initial investment for bank insurance is more and it requires more employees as well. It is useful for selling a few products only, and they need to arrange training for the people who will handle these processes because of a lack of vision and awareness. Obviously, banks, what banks have to do? They have to train their employees. They have to provide incentives to their employees to motivate them to sell one additional product like others. Because bankers are obviously trained to sell credit cards, trained to sell debit cards, trained to sell loan services. But with this bank insurance model, they also have to mold or change their mind to sell insurance products. Right? So overall, we can conclude that with the advantages and disadvantages of bank insurance model, it is basically a good notion or an idea to combine both life and bank insurance companies as it is best beneficial for both as well as it is beneficial for the customers. It is also good for customers because bank insurance offers all the facilities under one roof or at single stop. Staff from banks also get more incentives as they are selling more products and can become more productive. So it is easy for life insurance companies to get data of clients from banks because of which time required for data collection is reduced. So this is a benefit for bankers as well as insurance companies. It is a two-way business because a bank can sell products to insurance company and also offer bank products to the insurance clients. And last, for that level of insurance expertise, we will take training sessions so that all the bank employees will get ideas or knowledge about it. So overall, we can conclude that it is a in real a win-win situation for all the parties involved in it, that is bankers, customers, and insurance.